Welcome back to Talk Tickers. Today we're doing a critical deep dive into STMicroelectronics, that's STM, looking at their Q3 2025 earnings call from October 23rd.
Yeah, and this one definitely needs a closer look. It was really quite a strange report, actually, because on the surface, STM beat expectations, right? Top line, bottom line.
Exactly.
But the market reaction was, well, swift and negative. Very sharp sell-off. So what we want to do is unpack why that happened. Why did these, near-term margin issues and the forward guidance just completely overshadow everything else?
Okay, so let's start with that beat. The numbers themselves looked pretty good. Diluted EPS, both GAAP and non-GAAP, came in at 29 cents.
Yeah, and the estimate was around 23 cents. That's a solid beat, like 26%.
Definitely. And revenue, too, $3.19 billion, just edging out the consensus of $3.18 billion. So, yeah, they beat. But then, bang, the stock tanks. Why?
It really boils down to the quality of those earnings, and specifically that gross margin figure. It just fell off a cliff. That was the big red flag everyone saw.
How bad was it?
Down 460 basis points compared to last year, landed at 33.2%. Now, okay, they were still making money. Net income was $237 million, free cash flow positive at $130 million. But that margin compression, it signals deeper problems, utilization issues, maybe structural stuff. Investors just hated it.
Right. And I did see they were, trying to manage things they could control, like inventory. They brought that down by about $100 million from Q2.
Days sales of inventory down to 135 days. So balance sheet management, yes, they're doing that. But like you said, that margin squeeze just loomed over everything else.
So what was driving that margin pressure specifically, that 33.2%?
Well, the company pointed to a few things. Lower manufacturing efficiencies was a big one. Basically, their expensive factories weren't running full tilt.
Oh, like underutilization.
Exactly. Plus some negative currency effects. But the really critical piece, looking longer term, was this reduced level of capacity reservation fees.
Ah, those fees. That's where customers pay upfront to guarantee space, right? High margin stuff.
Very high margin, almost pure profit. And that stream is shrinking, and shrinking fast. That got people worried about future profitability.
Which leads us straight into the Q4 guidance, because that's where the pain just seemed to get worse. They guided Q4 gross margin to about 35%. Now, that sounds better sequentially?
It sounds better, but you have to look under the hood. That 35% includes, get this, an estimated 290 basis points of unused capacity charges.
Okay, explain that. Unused capacity charges.
Think of it like paying rent on factory space you're not actually using to make anything. It's a charge that reflects the cost of idle capacity. So that 35% number is kind of artificially boosted by accounting for that idle cost. It's not all from selling more stuff profitably.
So it's a headwind baked into the number. Management called 2025 a transition year, didn't they? So they're on the right path to fix margins through utilization, footprint changes.
Yeah, the usual transition talk. And to be fair, they were acting on costs. They trimmed their net capex forecast for the year, now expecting it slightly below $2 billion. Used to be $2.0 to $2.3 billion.
So they're pulling back on spending. Smart in this environment, maybe. But let's go back to those capacity fees you mentioned. The unused capacity charge might be temporary, cyclical, right? If demand comes back.
Hopefully, yes. That part is cyclical.
But the loss of those reservation fees, that sounds more permanent.
It absolutely is.
Yes.
And that's the structural cliff that I think really spooked investors. These fees were steady through 2025, a nice cushion. But starting Q1 2026, as contracts roll off, that income drops significantly.
So it's a guaranteed headwind for next year's margins. They need to find real product sales to fill that gap.
Precisely. Just to stand still on margin percentage, they need to grow actual product revenue quite a bit.
Okay, so margins are under pressure, both cyclically and structurally. What about the top line then? Q4 revenue guide, about $3.28 billion, only up 2.9% sequentially. That sounds pretty weak for Q4 seasonality.
It is weak, significantly below their typical seasonal pattern. And management was pretty clear why. About 80% of that miss versus normal seasonality comes down to two main things.
Okay, what are they?
First, ongoing industrial destocking. We need to be clear what that means for listeners. POS, point of sale, which is actual sales to end customers, is running higher than POP, point of purchase, which is STM's recognized revenue.
Meaning distributors are still selling off the inventory they already have on their shelves before ordering more from STM.
Exactly. The channel is still clogged. That's the first big chunk.
And the second factor?
a drop in those capacity reservation fees again, but also lower actual volumes from one specific important EV customer in their automotive segment.
Ouch. Automotive is supposed to be the big growth engine, and year over year, that segment is still down 7%.
Still negative year over year, yes.
Yeah.
Even though it grew 10% sequentially in Q3, driven by most regions except the Americas. So the destocking and this EV customer issue are hitting a really key area.
Did they mention any wins in auto despite the headwinds?
Oh yeah, they highlighted wins. Silicon carbide, CC, devices for traction inverters, onboard chargers, crucial EV components, also MEMS sensors and imaging sensors for things like monitoring inside the car or road noise cancellation.
Right. See, assigning those wide bandgap materials, they're essential for higher power, higher efficiency stuff like EVs and data centers. Much better than standard silicon for those uses.
Correct. The strategy makes sense. But the near-term pain, it's really showing up badly in the power and discrete segment. Their operating margin there in Q3 was shocking. Negative 15.6%.
Minus 15.6%. Wow.
Yeah, really bad. And fixing that is tied directly to how fast they can execute this COC transition, specifically moving from the older 6-inch silicon carbide wafers to the newer, more cost-effective 8-inch wafers.
That sounds like a complex manufacturing shift. And they're calling 2025 a silent transition year because of inventory issues with the main customer. But you hear transition year a lot right before companies miss expectations, don't you?
You absolutely do. That term often signals delays or difficulties ahead.
Given how long this industrial destocking seems to be dragging on, is there a risk the CLEC ramp takes longer than they host, maybe past 2026, and that segment just keeps burning cash?
That's the million-dollar question, isn't it? And it's clearly fueling the skepticism. Management says they believe 2026 will be a clear growth driver, new programs ramping in Europe, China, but the market's looking at the immediate volume loss, the execution risk of the 8-inch transition, and it's voting no confidence right now.
It wasn't all negative on the strategic front, though, was it? I saw mentions of some interesting partnerships in tech.
No, definitely not all bad. They announced a new license deal with a company called Metalens. They'll use STM's advanced 300mm manufacturing lines to make something called metasurface optics. Think tiny flat lenses for things like smartphones or maybe LiDAR sensors.
Interesting. And anything on AI, that's obviously huge right now.
Yes, they noted they've done full power testing on a prototype gallium nitride, or GaN-N, based power solution specifically for AI data centers, and they hit over 98% efficiency.
98% plus, that's really efficient for data center power.
It's world class.
Yeah.
So the innovation pipeline seems okay. And don't forget the NXP MEMS sensor deal. That acquisition, valued up to $950 million cash, is still apparently on track to close in the first half of 2026.
Right, strengthening the sensor portfolio for auto and industrial. So the long-term pieces seem to be moving forward, which just makes that immediate 13% stock drop even more jarring. Why such a violent reaction?
Well, I think investors were already on edge. If you looked at the STM ADR, the U.S. listed shares, they were already lagging the main semiconductor index, the SOX XETF, quite badly over the last, 1 month, 3 months, even the past year.
So sensitivity was already high coming into the call.
Very high. And then you get this weaker than expected Q4 revenue guide, plus this double whammy on margins, the temporary utilization hit and the permanent capacity fee drop. It was just too much negative news at once.
But the market just focused on the immediate pain points.
Completely. They prioritized the Q4 guide miss and those margin headwinds over the longer term stuff like the capex cuts or the cost resizing plans. Near-term fear just won out. Big time.
Okay, so looking ahead, what do investors need to see to get some confidence back? What are the key catalysts?
First, they absolutely need to hit that Q4 gross margin guide of around 35%.
Yeah.
That's table stakes now. More importantly, we need to see clearer signs of utilization improving as we go into the first half of 2026.
And confirmation the destocking is ending.
Yes. Confirmation that the auto and industrial destocking is really, truly bottoming out. Management thinks second half of 2026. For that, we need evidence. And finally, concrete proof points that those 8-inch STMicroelectronics programs are actually ramping up successfully and contributing.
Okay, so given this massive sell-off, this disconnect, is there potentially a trade here for someone maybe willing to look past the immediate noise?
All right, let's put on our this is not financial advice hats, purely informational discussion here. But yeah, the setup for a contrarian view is pretty clean, actually.
Yeah, so
You've got this huge stock drop based mostly on what seems like temporary stuff, the factory utilization charge, the inventory backlog. Meanwhile, the longer-term strategic story-cutting costs, the C6 ramp in 2026, reshaping their manufacturing footprint, it all seems basically intact.
Okay, so let's call it the footprint reshaping recovery trade. The idea is you buy STM now, arguing that the 13% hit already reflects the Q4 miss and even that structural margin hit from the lost fees. You're buying the recovery path.
Exactly. And to maybe enhance that or reduce your cost basis while you wait, you could consider selling a shorter dated out of the money put option.
So collecting premium by basically betting the stock won't fall much further from these levels, capitalizing on the high volatility, the panic.
Precisely. You're capitalizing on the market's freak out over those 290 basis points of utilization charges. The whole trade hinges on management actually delivering, though. They have to cut those structural costs, like maybe closing older 200 millimeter fabs to kill that rent on empty space. And that CC growth in 2026 needs to materialize. It's a bet on execution.
Okay, so to recap, we saw the headline beats, but then this sharp sell-off driven entirely by margin fears, both the temporary utilization kind and the more permanent capacity fee loss. Q4 guidance was weak due to destocking and that EV customer issue.
But underneath, the long-term strategy around SICIT, Gianniken, sensors, and cost-cutting continues. The core issue isn't just this cycle's inventory problem. It's structurally managing their factory capacity effectively, balancing that short-term pain with the long-term investment.
So the final thought, the big question for you listening is this. Can STMicroelectronics management actually reshape their manufacturing footprint and cut costs fast enough? Fast enough to offset the expected price pressure, maybe low to mid-single-digit declines, and more importantly, that definite structural drop in those high-margin capacity reservation fees. That race against time is really what's going to define 2026 for STM.
It's a critical balancing act. We'll be watching closely.
Absolutely. Thanks for joining this deep dive. Remember, all this is just for informational purposes. We'll see you next time on Talk Tickers.